Now we come to something interesting for foreign companies and where the international transaction is involved. So there is a provision of transfer pricing where you are carrying on the transaction with your related party for the international or specified domestic transaction. You need to do a TP benchmarking annually every year, wherein there is a way to determine whether the transaction entered by you with your related party is within that arm's length price or not. Now, what they said that you don't need to do annually. You can opt for a block assessment for 3 years. Of course, you need to apply and TPO will confirm. Wherein you said this. So suppose your cost plus entities and you said that my margin is say 15% or 20% as per TP study, that 15 or 20% will remain same for next 2 years. So you don't have a botheration or you don't need to do this exercise or you need to don't need to worry also that now for next 2 years again there will be assessment and it's subject to all this production of documents. And so they've now given a 3 years block. So this is also going to be a lot of benefit to the taxpayer if they opt for it. And this is in line with international best practices. They also said that the safe harbor provision will be expanded to include more transactions. The safe harbor provision are also very beneficial, wherein if your transaction is within that uh, boundaries, then you can very well take it and I'm safe in terms of my transaction within the permissible limit. So there were some transactions which has already been there. Now they said this we will include few more transactions under the safe harbor provision. Of course, once it comes out, it will be notified. Yeah, there is a presumptive tax. First, I'll take this third one, amendment to scope of significant economic presence in India. So, friends, those non-resident who have some business connection in India or a significant economic presence, their income is subject to tax in India because they carry out transaction in India and it is deemed that the profit or the income accrues to them because of their presence in India. Now they have specifically carved out one transaction, which is only say that if your transaction is confined to only purchasing of goods in India, only for sole purpose for exports. So if suppose some non-resident entity is purchasing some goods in India, which is only and only getting exported, then that uh, they will not treat these as a business connection for significant economic presence. So it's a big relief for those person who are doing only such kind of activity. They don't need to bother about taxation in India. That's the third point. The first point is those non-resident who are providing services or technology for electronic manufacturing facility. So why this was introduced, that the government thrust is on manufacturing, especially electronic manufacturing, because we import a lot and we spend a lot forex on this electronics import. So they are, of course, apart from PLI benefits and other benefits. Now, for a non-resident also, they say that, okay, you also don't worry if you are providing some technology to our Indian manufacturer, or if you are providing some services to your. They said, whatever you provide, whatever amount is received, only 25% will be treated as profit. And on that, you pay the tax. So this is also very welcome where, the non-resident are not subject to you prove that, out of 100 rupees received, this is going to be my actual income, this is my expense, this is the allocation towards profit. Nothing to be done. It's a presumptive. So 25% straight will be treated as a profit and you pay tax on that. And the tonnage tax scheme has been now extended to inland vessels. So these are all relating to now the NRIs or foreign companies. Uh, there are still few amendments which are not significant, but they are already covered in our publication on the budget. Uh, One or two, like AIF taxation, where you are a registered AIF. Uh, there was some kind of confusion that if the income of AIF in terms of say selling the security, whether it is a business income or not, while the securities are basically is a capital asset, but there was a not clarity about whether it's a business, because the business of AI is yes to buy the security, invest the security, and sell the securities. So to remove the difficulty here, now they said this will be treated as capital asset. So that income, which is of course a pass-through income, of course this income is passed through the to the beneficiary. Now the beneficiary will be taxed as a capital gain, not a business income. This is also quite a good welcome, clarification given by the government. And there's a ULIP taxation. Uh, as you know that any annual contribution to ULIP policy about 2,50,000 was subject to tax. But again, no clarity how it's going to be taxed. Now they said it will be treated for taxation as a similar to the equity mutual fund. The equity mutual fund either it is short term, long term, and 12.5, 20, 10. So the same rate of tax will apply to the ULIP, wherein your annual contribution is more than 2,50,000. If it is less than 250, well, it will anyway exempt. So like that, you know, there are small benefits or changes in the tax laws. Um, I think I have covered most of it in terms of economy and direct
बंद
tax.
करो म्यूट करो
So uh, we will take up the question later on, but before I move to indirect tax, which will be taken by Reena, uh, just few points which are important for you to note down is that uh, this new tax regime and old tax regime, one has to be very careful while filing the return that by default now the new tax regime is a default scheme. So if you file the return, it will be treated as if you file return the new tax regime. So if you're filing under old tax regime, then you need to intimate by way of saying that I want to offer the old tax regime. So these are the finer points you need to take care of it.